Uh, Welcome, guys. I want to explain to you this question on consolidation. It's a comprehensive question, a typical exam question. So let's start here. Ben acquire 112 ordinary shares in Ken on 1 January 2009. So that is our acquisition date. So this trial balance that is presented to us here, this is the situation at acquisition. Okay. So Ben paid 190 to acquire the equity of this company, which is this one. Okay. All right. That's the equity. And this 190 covers 112 shares out of a 160. Okay. Number of shares. So let's do this and say the share is, let's make it 1 rand per share. So we know that each share is 1 rand. So if we've got 160 and you bought 112, that should give you a percentage of, let's check, 112 divided by 160. It's 70%. It's 70% per share, the percentage holding of Ben in Ken. Right. Let's just basically do date by date. Let's start with at acquisition because we've already dealt with at acquisition here. Let's start with at acquisition. When you acquire the company, this is the equity that the company has. So let's start with at acquisition. Here is at acquisition, where you've got this equity and it must be shared into 70, 30, 70%, 30%, 70%, 30%. Right. Then once you've done that, you'll see that this is 196. Okay. But how much was paid for that net asset value of 196? You'll see here, Ben paid 190, right? So Ben paid 190, which means Ben paid less than the net asset value. The net asset value is 196, so they paid less. So you see there's a gain on bargain purchase of 6,000. Right. Now, this side here, you've got 48, 24, and 12, giving you 84,000. So now, in this exercise, that line which talks about the fair value of non-controlling is not there. If you look at this information here as a whole, there's nothing being said about the fair value of non-controlling. So if nothing is being said about the fair value of non-controlling, you leave the figure as it is. There's no adjustment. Put 0 here, and then there's 84 here. Now, you'll see that in total here, we've got this gain of on-bargain purchase of 6,000. Okay. Right. So 280 minus 6 gives you 274, which even when you add the two figures here, they give you that figure of 274. Okay. Now, you see this gain on bargain purchase, this one here. From here, it forms part of the opening retained earnings, meaning this is it's supposed to be here. Here is it. Here's the 6. Okay. That is the 6. That is from here. This 6 here is the one that you see here. Okay. So the gain on bargain purchase forms part of the opening retained earnings, meaning it forms part of this amount here. This amount here, it forms part of it. You can see where we said number 2. The 6,000, which is the gain on bargain purchase at acquisition, is that one. Okay. Okay. Then we we continue now in terms of this exercise. So we've covered what we call date number 1. Remember I said to you that the analysis has got 3 dates. So this is date number 1 at acquisition, which we've done now. Right. Now what we want to do is to move to the next date now. You see the information presented to us is for 31 December, which means that is our current year now, post-acquisition. Right. Now what you must do is you must analyze the equity, this one, from at acquisition to now, which is this one here. You see there's no movement in share capital. Then you go to asset replacement to say 40. Okay, here, no movement. So you don't do anything when it comes to these ones where there's no movement. Now here's 80, but there's a movement now to 160. So now post-acquisition, this company has earned 80,000 in retained earnings, 160 minus 80. Now here it is. So I'm dealing with this date now here, this date here. All right, you'll see when it starts this thing, it says 160 minus 80. So, 80,000, 160 minus 80,000. They are talking about the difference between at acquisition, the 80,000 and the 160. So there's a change now in this one, 160 minus 80. Okay. All right. Now, having done that, we now need to look at issues here. Let's deal with this so that we can then be able to answer this question. Let's start here. This says Ken Limited sold inventory to Ben at an agreed profit margin of 25% on cost. The amount of sales between the two companies amounted to 160. Now, the first thing you must understand is this. When we were talking about intra-company transaction, we said any transaction between the two companies must be eliminated on consolidation, meaning when you combine the two companies, you must eliminate those transactions. Now let's think about this thing here. Let's look at the sales. The amount of sales between the two companies amounted to 160. So Ken sold inventory to Ben. So Ken is showing 160 under sales. Right. Ken is showing 160,000 under sales. So meaning we must eliminate that 160, which is sitting in Ken's book under sales. And they sold this inventory to Ben. When Ben receives this inventory sort of 160, it forms part of the purchases. Right. What impact does it have? It increases the cost of sales, this 160 under Ben. Now, how do we eliminate this transaction of 160? Number one. So this 160,000 is an amount of sales. Right. So here is the 160 here being eliminated. You see in the income statement, the sales and the purchases are being eliminated there. Now, some of you will say, why is this 160 under cost of sales? When the company is buying, meaning the one that is buying, it forms part, the 160 forms part of cost of sales. If you minus the cost of the 160 from, the 160 forms part of purchases, it forms part of purchases in that company. When you minus it, it has got an impact of decreasing cost of sales. So that's when you're eliminating it. So that's how you eliminate the 160. Okay, you eliminate it here, this 160, and you also eliminate it here. Right. Now, let's then come to this part here. Right, in that same line here. Let's deal with this one here. All right. Now, again, when we go back to intra-company transaction, the intra-company transaction says you can make a profit by selling to yourself. So Ken sold inventory to Ben. So Ben is carrying inventory which has got a markup of 25%, while Ken has made a profit. But now what happens is this: when you combine the two companies into one, Ken is bringing a profit. Ben is bringing inventory, which has got a markup. But now the rule says eliminate the profit in Ken and reduce the inventory. Take out the profit margin, which is sitting in Ben's inventory. You take it out. But I will explain to you how do you do that. Now, here is Ben holding these inventories, okay? Because Ben is the one that is buying the inventory, okay? So Ben is holding this inventory of 18 on this date and is holding the inventory on this date. I'll start with the top one because that's the one that is relevant for date number 2, which is beginning of the current year, okay? It's closing last year, it's beginning this year. Now, if the margin is 25% on cost and this one has got 18,000 worth of inventory, let's then find out how much is the profit margin that is sitting in that 18,000, meaning that forms part of the 18,000, right? So the profit margin, here it is, here's the calculation. This thing is sitting as 18, right? Here is the cost price at 18,000, right? When the 25% markup. Now here's the markup. This is what we are interested in. This markup. This is what we want. 25 over 125 because it's at cost. Okay. So meaning this is the profit that this company is making. But then the rule says you cannot make a profit by selling to yourself. So that profit margin must be eliminated. Now, in between these two companies, who is selling to who? Now, if you check here, Ken is selling to Ben. Ken is a subsidiary. Ne? Ken is a subsidiary. Since Ken is the subsidiary and is the one that is making a profit, it means when you do the analysis of equity of Ken, the profit that Ken made by selling to Ben is there in the books of Ken. So you must go and eliminate it there in the analysis. Okay. You can only adjust the analysis if the subsidiary is the one that is selling. In this case, the subsidiary is the one that is selling. The profit is sitting with the subsidiary. The asset, which is inventory, is sitting with the holding company, which is Ben. So you go and adjust. You say, okay, since I know that here, when we are here, let's talk about this because I'm dealing with this amount here. Okay, so when I'm here, I know it was 160 minus that. That is at acquisition and post-acquisition movement in retained earnings. Then I want to minus this 3.6. Let's check if it's 3.6. Yeah, we said 18,000 times 25 divided by 125, if I remember. Yeah, I'm minusing this profit. So what this thing is saying to you, this subsidiary made a profit by selling to Ben, and Ben is the holding company. The subsidiary sold inventory. The subsidiary is the one that is making a profit. Ben is carrying the inventory. Now, since this is an intra-company transaction and none of these companies is allowed to make a profit by selling to itself, so you must minus this profit that the subsidiary made. You must add the tax that goes with 3.6. You see the 3.6 times the tax. If you minus this profit that is a subsidiary made, this is the tax, 30% of the 3,600. Okay. Right. Now, then what you need to know is that if you are reversing this, remember this is closing inventory. It's closing inventory, okay, in that year, in 2010. You can see it's closing inventory in 2010. Right. But be careful because when you start 1 January 2011 now, meaning the following year, that closing becomes opening. This closing becomes opening the following year, which means the only thing that must change are the signs. Remember, opening is plus, closing is minus, okay? So you will see that this one tends to become the opposite here. Do you see it here? because there, where what I've highlighted, it is now opening there. It's opening. This amount that was closing last year becomes opening the following year, and it changes the sign. Okay. You'll see that this amount is now here. It's part of this. Okay. Meaning the current year, where it becomes opening. All right. It's closing here. It's closing here, which is this. It becomes opening the following year, which is sitting in this amount, which is this. All right. Then we deal with the inventory for this year. Let me show you. We deal with the inventory for this year. Here's the current year calculation. The markup that we must adjust is this one here. Here's the markup. It's this one. See, this is the markup that we must adjust. Okay, so we must reverse 6,000 because the subsidiary made 6,000 when it comes to this inventory that we are being shown. It made 6,000, but you can't make a profit by selling to yourself. So we must minus it from the profits of the subsidiary. Here it is in this current year. Minus 6. Then you add the tax that goes with the 6,000. 6,000 times 30% is 1.8. So you see that. So we reverse this. Okay. Right. We reverse the profit, and then it goes with the tax that goes with it. Okay. This one comes from last year, which is this one here. But remember, it's closing here, it's opening here. Okay. All right. So we are dealing with this figure slowly but surely. So this figure here of 88,200 is a figure that you get by going to this company here. You start from here where it says revenue. You go up until here. All right. You go up until there. Okay. That's the figure that if you add all those figures here, they will give you this. Where's this figure? This 88,200. Okay. This one here. Now, I know there are figures that I've not dealt with there. I'm going to go to them now. Let's then go to the question. So I've dealt with this inventory here. Right, I've dealt with this inventory. Right, let's come to this one here so that we don't basically miss things. So ban renders administrative duties to CAN. Okay, so one is going to have administrative expense, one is going to have administrative income. 2,000 times 12 months is 24,000. So now the rule is that when you do an elimination of an intra-company account, meaning a transaction between the two companies, you must eliminate it twice. Okay, you'll see one is bringing an administrative income, one is bringing an administrative expense. You see, here's the income when we're minusing it here. You see the 24 minus 24 under income. Then this figure, we must have something to, let's see, because I'm not seeing the second part. Let me check. I want to see why I don't see the second part. Okay, see this one. If you've got that one, it's administrative fees paid. If you eliminate it as a whole, it becomes 0. So that's the reason why you don't see it there forming part of the expenses. So because let me check something here. I think they've just eliminated it from that level, but I think they should have. I'd be more comfortable with us doing this. I'll be more comfortable if we do this. 24, 1, 2, 3. minus. I'll be more comfortable with that, because I will then be able to show that this 24 is this one here. But then, because it's an intra-company transaction, it was eliminated as a whole. Here, it was eliminated here. Okay, so then that gives me 2 entries, and it makes sense to some of you, because some of you will ask me why now this one doesn't have a contra, meaning or 2 eliminations. There, I think it should work this way. It will look nicer and right. Okay, we've dealt with the 24,000, which is intercompany. Right, we've dealt with the 22,000, which is intercompany. Right, that 24. Now, before I move on, let's go back to inventory now. Right, inventory. No. Okay, let me just leave it for now. Let me leave it for now so that we can see. Let's get figures that are in the analysis so that we can move on. On 1 January 20x10, BAN purchase a plant from CAN. You see now again, BAN is the holding company, is purchasing from CAN. So CAN is going to make a profit or loss on sale of an asset, and BAN is going to hold the asset. Okay. Now CAN had purchased this plant 5 years previously for 36,000. BAN Limited agreed with the remaining useful life. Depreciation on plant is at the rate of 10% on a straight line with no residual. Depreciation is included. Okay. Now, 10% is 10 years. Okay. You need 10 tens to get to 100. So, if this thing was purchased 5 years previously, now it tells me that already half of this amount has been depreciated, because it's 5/10. That has already been depreciated. Okay. Now, let's get to deal with this calculation. Right. This company bought this thing for 26. Right. Now, let's start from the beginning. The asset was 36. For 5 years, it has been depreciated, meaning 18,000. So now it's sitting at 18. So we're looking at the books of CAN, the first person that bought it, meaning who bought this asset first? It was CAN. Then CAN sold it to BAN. Okay. We start with that one. You must always start with the company that bought the asset first in the group, which is CAN in this case, and then CAN sold it to BAN. Now, CAN, by the time the carrying value was 18, they sold this asset for 26, which we've noted here. Right, we've noted here. Right. Now, when it's 26, it means the unrealized profit is 8,000. Right. 30% of this 8,000 is the 2.4, which is the tax. The 2004 is 30% of the 8. Right. 8,000 times 0.3 times 8,000, which is 2.4. Right. Now we look at date number 2. What happened in date number 2? This asset is left with 5 years. Okay. If 18,000 you divide it by 5, 18,000 divided by 5, it's this one here. All right. And then it gives you the carrying value by end of the prior year. And then you continue to the current year, the depreciation, and then you get to here, the carrying value. Right. Now, let's deal with this column here. So it's 26. What's the remaining useful life? Out of 10 years, we've already depreciated 5 out of 10 years. So we're left with 5. 26,000 divided by 5. Divide by 5. You see, it's 5.2. If you divide by 5 years, the 26,000, if you divide, it gives you this, which is 5.2. Then it continues to be 5.2 even in the following year, right? Those are the carrying amounts in Ben's book. Okay. Now, let's deal with this thing so that you can understand. Now, the question then will be that if Ben is putting 5.2, according to consolidation, always the correct depreciation is the depreciation of the person that bought the asset first, so the asset first, which is Ken in this case. Ken bought the asset first and he was depreciating 3.6. So the correct depreciation will always be 3.6. So although the asset is sitting with Ben, when you consolidate, Ben is bringing a depreciation of 5.2. So we are saying that depreciation is incorrect. We must reduce it by 1.6 because the difference between the two depreciations is that 1.6, which is this one here, right? And then the tax that goes with it is this one. Now, your unrealized profit is 8,000 and you've realized 1.6 through usage according to accounting. If you keep using an asset, you are realizing part of that amount, okay? So by end of this date here, which is date number 2, by end of it, your unrealized profit is 6.4. And the tax that goes with it is 1920, okay? So let's go to the analysis. In the analysis, you'll see by end of date number 2, because the subsidiary is the one that is selling, you need to minus this profit and add the tax. Now, 6.4, why are we minusing 6.4? Because the subsidiary is the one that sold the asset, and the subsidiary is the one that made this unrealized profit that we are talking about here. Here's the unrealized profit that the subsidiary made, 8,000. But through usage of the asset, we've realized 1.6, which is the difference between the two depreciations. And we know that the correct depreciation is 3,600, which is this one, okay? According to consolidation, it says the carrying value of the person that bought the asset first, the depreciation of the person that bought the asset first are the correct amounts. Right. So by end of that period here is what is left of the unrealized profit. So we then say, let's deduct this amount. Here it is in date number 2, which is for this amount, right? Then after doing that, then you say, okay, I'm going to split my profit now, or my retained earnings amount in date number 2 into 70, 30, right? And then this whole thing now adds up. See, you've got your 5 point, you've got 105,900 because you're adding this and this, okay, to get the 105,900. Now, here, let's deal with this. Now I'm going to deal with this one. There's a part that I've not dealt with, so you can see. Now, when you're in the current year now, in this calculation, here's your current year. This is your current year. Here, okay. So, Ben is going to put 5.2 in the books. And the rules of consolidations are saying Ben cannot put 5.2, can only put 3.6, which is the correct amount. But remember that this company called Ben is the one that bought the asset. So Ken, which is the subsidiary, made a profit, which is unrealized. But every time they realize a 1.6 with this, in the current year, now I'm talking about the current year, see the date. In the current year, this company made realized this much of the unearned profit. Okay, to take the amount now to 4.8. Now, you'll see here is this amount. It's a realized amount. You'll notice it's not a minus, this one, it's a plus. It's amount that has been earned through usage, 1.6, minus the tax that goes with it. So now we've covered this figure here. So 70% of it is this one, 30% of it is that one. Right. Then we deal with the dividends. Dividends. So when this company declares this 40,000, you need to know that this 40 is then distributed into two amounts. This 40, 70%, which is for the holding company. 30% is for the non-controlling. Okay. Now, If you then look at that now, we've covered that date too. Okay. All right. Now, we've covered the analysis. Now we go to the income statement. Obviously, the figures in the income statement, we will say subsidiary plus holding, like for an example here, subsidiary plus holding company minus the 160 that I've already dealt with, which is intercompany. Again here, this plus that minus the 160 that is under purchases. We are decreasing the purchases. Okay, it forms part of decreasing the cost of sales. Now you'll see that there are two figures here. There's a plus and a minus. All right, let's deal with those figures. You will see that, let's take this one. You see this 6,000 is decreasing profits because the 88 is profits. No? 88 is profit. So this 6 is decreasing profits. This 60 is decreasing profit. What's another way of decreasing profit? It is to increase an expense. If you increase an expense, cost of sale, the profit will go down. You are doing the same thing that you are doing here. The difference is that here you are going directly to the profit line. You are decreasing a profit line by saying minus. You are going directly to it. Now, when you go to the income statement to show that transaction, the one that I've highlighted, you increase an expense. If you increase an expense, the profit will go down. So it's the same thing as what you see there in number 2. It's the same thing as this thing. Except this one, we are decreasing profit directly. Here, you are increasing an expense, which will decrease the profit eventually. All right. Then you look at this one. This one says plus the profit in the profit line. So what are you doing here? We are increasing profits in that line. We are increasing profits. Now, how do I increase profits? I can decrease expenses. So doing the same thing, this same thing that I'm doing here, how do I do it here? I decrease an expense. If I decrease an expense, the expense goes down, the profit will go up. So I'm doing the same thing that you're seeing here. Okay. Right. So I've dealt with this line item and this line item. And now, please be very aware of this because it's easy to get lost sometimes. You see, if I increase an expense, the profit goes down. If I increase an expense, the profit will decrease. If the profit decreases, the tax must decrease also. Look at this. The 6,000 goes with the 1.8. You see, minus tax is decreasing the tax. If you increase an expense, the profit will decrease. If the profit decreases, the tax will decrease. Here's 1.8, which is the same amount that I'm saying here. Okay. All right. If I decrease expenses, the profit will. If I decrease an expense, the profit will go up. If the profit goes up, the tax will go up too. Plus 10.8. Okay. Plus 10.8. Now, we've dealt with that. Now, let's come to this one. You see, this amount here is intercompany, is an amount that has been given to the holding company. It will be given to the holding company, and it will form part of this amount here. I'll show you where it is. This 28. This 28 is here. It's part of this amount here. See this amount. There's a 28,000 in that 36,000, which comes from Ken. By virtue of Ken declaring dividends, 28,000 will come to Ben because Ben is the holding company. So in that 36, there's a 28, but the rule of consolidation says any transaction between the two, meaning this 28 is paid to Ben. You can see it sitting here in that line here, Ben. So any consolidation rule says if an amount is between the two companies, it must be eliminated on consolidation. So that 28 is eliminated against the 36, okay? Right. Then it says plus 36 plus 10, which is other income. Let's see, what is that? Okay, this is this 36 and is this 10. And then you minus already what I've explained, which is your your administrative fees income. Right, then you come to this one here. Already I've explained this part. So here you say holding company plus subsidiary minus 1.6. Let me explain to you why there's a minus 1.6. So remember, this company is the one that is holding, this company here is the one that is holding the asset. Ken made a profit by selling to Ben. Ben is holding the asset, and Ben is going to depreciate the asset at 5,200 this year. But the rules of consolidation says that the correct depreciation is the depreciation of the person that bought the asset. So they are saying the correct one is this one. How do I adjust this figure to this one? I must decrease it by 1.6. Right. Here is the minus 1.6. And again here, if you decrease an expense, the profit increases. If the profit increases, the tax must increase. Okay. The tax must increase. Right. Now I believe I've explained all the figures that I see in the income statement. So once you are done, you add all those line items, and then they will give you the figures that you see this side. Okay. Then the profit for the year is 502,040. Now you must split it. You'll see here, you must split it into the people that are entitled to it. Now, you see this line here in date number 3. Every time in line with current year profit, this 26 will come from there. Here is it. That's your starting point. You put the 26. And then you can then say 26 minus this one will give you this one, isn't it? Then you add them up. Then they must tie up. They must agree, these two, you see. These two must agree. Okay. So always be careful that when we are marking, you will look at this. When you put a figure at this one, we come back here. We look at this one. If it is the same thing, okay? Right. Then from there, this figure that you see here, this one, every time from there it goes here. It must come here. It must come here. See, it comes there. Okay. Right. Now, let's then deal with this. The statement of change in equity. The share capital must always be the share capital of the holding company, meaning always it must be this company here. Here it is. Right. Always. Right. Then we come to, I'll try to move to here. Okay. Let's start with the easy things. This column here must always match this column here. Let me check something here. Something doesn't look right. 84 plus 21. The total there doesn't look right. Doesn't seem to be adding up. 84 plus 21, 900. Okay. Okay. This one is correct. The first one is correct. This one is correct. It comes from adding this one. It's this one here. 84 000 plus 21 900. It gives you 105 900. Right. Then you add the 26 after and the 12, which is correct. This one. Here's the 26. Here is the 12. Let's double check. 26 292 minus 12,000. Okay, it's fine. It's fine. It gives us this 14. 14 plus 105, the opening balance 900. It must then give us 120. This thing doesn't look right. Let's give us 120. 192. Right, now how I knew that this one was not right, because the answer must be the same as this one. It's like you are transferring figures from this analysis to here. It's the same thing. You are transferring figures, so they must agree in terms of the final figure. In fact, the transactions are the same, because what you do, you say this plus this gives me 1095. Here's the 1095. Then after, then you say, okay, after the 1095, I've got these two transactions. Here they are. And then add the 2, then they give you 120. That is the reason why they agree, because you are transferring figures from here to that side. Okay, we've dealt with the easy stuff. Now let's then deal with asset replacement. Asset replacement, the opening amount, you'll say P. You'll say P, which is this. And what is P entitled to until date number 2 in the analysis? Where's the analysis here? Until this date here, there's nothing which is a asset replacement here. You see, it's only retained earnings. So it's P, which is 60 plus 0. It gives you this. Right. In this exercise, there's no movement in terms of asset replacement. Right. It's like that. So there's no movement. So it's 60 by end of that period. Okay. Now let's go to retained earnings. Let's deal with this amount. We've already explained that this is the gain on bargain purchase. Okay. When we were talking, we said the 6,000 is the gain on bargain purchase. Now, the first step is what is the opening retained earnings, meaning 1 January 2011. 1 January 2011, what is the opening retained earnings of the holding company? Is this one, 160. And how much is the holding company entitled to as retained earnings until date number 2? You come here, here it is. It's entitled to this much. Okay. Right. So 160, which I've showed you under P, plus what P is entitled to under analysis, plus the gain, gives us this opening amount. Please show this. Please show it when you are calculating. Please show it in your calculation, and when you're answering, you must show this calculation, because your marks are there. They are not here. This one won't give you marks. The one I've highlighted, the marks are here. The marks are here. You must show us how did you get that figure. Right. I've already explained that the figure from here must come here. Please don't change figures. Right. Then always put the dividends declared of the holding company only there. Or because I'm giving a shortcut, always put the dividends of the holding company there. If you then add everything up there, plus okay, that agrees to that. Always put your totals here. Put your totals. Right. So the figures that you see in the analysis of equity, all these ones where I said put your totals here, meaning these ones here, and these ones here, you see. These ones. So from here, they go to here. You see, none of the figures has changed. They still look the same. So when you are also dealing with this thing, don't change your figures, okay? All right, let's then deal with the easy stuff. Holding company plus the subsidiary. Now, let's start with this easy one. You said holding company plus subsidiary minus 3.6 when it was closing, plus 3.6 when it is opening, minus 6,000 when it is closing, meaning I'm talking about these figures here. Here are the figures I'm talking about. You see, this thing here started when it was closing. Then it became opening, right? And then there was this closing now, this one here. Okay. Okay. So in a nutshell, let me try and see if I can explain something here. Okay, let's look at, let me see. Yeah, let me put this thing here. In a nutshell, when you start dealing with this amount, let's talk about this one. so that you can understand. You see this one here. This is the entry that you made. You said cost of sales 3006, right? And then you said inventory 3006. You see that? Now, when you are dealing with this one, okay, you see the 3.6 here, right? And it symbolizes this one. But remember, this amount, it was closing inventory. When it becomes opening, you reverse this entry. You do the same entry, but you put now the opposite of it. You say, if you reverse this entry, it means here, let me show you. What's the reversal now? If you reverse, you'll say now here, inventory, inventory 3.6, cost of sales 3.6. Now, do you see? If I then put a debit in inventory, it's this one now, right? So if I then do the 6,001, it will look like this. It just this one there, the 3.6 part, the first one. It will look like this one here, right? The 6,001. So that is why it's minus, you see, because it means now I'll put 6 here, 6 there for the current year, and then it looks like this. Now let me show you that these entries move the same. So this is this entry here is done in the prior year, not in the current year. When it reverses, it happens in the current year. This part, the reversal. Now, the part that is here, this one here, which I've highlighted, it is done in the current year. So you say plus, here's the plus, minus 3.6 in cost of sales. Look at this. Yeah. Right. When you do the 6,001, the 6,001 will be like this one. Like this one will say 6,000 here. And then you'll say 6,000 here. You see, this is this one. Right. This one, here it is. Debit cost of sales. Okay. You see. So what you are doing there, you are showing all the reversals that relates to the inventory. Right. Now, let's do the easy one. This one, why are you saying here minus 4.8? It is the carrying amount of the unrealized profit by end of this year. Here, by end of this year, here's the unrealized profit. It's 4.8. Okay. It goes with the 144, okay, which is deferred tax. Now, if you then look at this, you'll realize that here is your 4.8. Okay. Now, let's then now deal with, let's check deferred tax. What does it say here in the question? Okay. I'm just trying to check. Okay. Luckily, the question is not giving us deferred tax, so it means we are starting it from scratch, but it's not a problem. Okay. Okay. Now let's deal with this deferred tax. But I don't like here. You see this thing here, it says plus 192 minus 48. If I were here, I would just go for the final figure, because if you take that minus the other one, it gives you this. I will just go straight for the answer. It gives you this 144. You see, it gives you that 144. It's a long way. I could just put one figure rather than the two. I'll just say plus 144. If I wanted to, I'll do this. and then I'll eliminate this. So it should be fine. The answer will still be the same, I think. Okay, it's still the same. Right, and then we deal with the deferred tax, the 1080 and the 720. Here is your 1080. Right, it comes from there, the 1080. And I'll show you where does the 720 come from. 3.6 times 30 is 1080. 1080. 1.8 minus 1080. Right. Okay. $720. So the taxes between the two amounts. Where is this? Where are these amounts? These two. If you take the tax that comes with this and the tax that comes with the two, this 6,000 and this one, they should give you 720. 30% of that one and 30% of that one, you take the difference, they will give you 720. And then the 1080 is for the first amount, which is this one here, the one I've highlighted. If you take this one, it gives you 1080. Now I'm trying to figure out this thing. 1080 plus 720, they're doing the same thing. I would have just reflected the depreciation of, so the tax of this one. 6,000 times 30 is 1,800, right? Which is what, this one, which is this. You see, so there's nothing wrong about you saying my answer is 1.8 here, and I'm going to delete this. Here I'm going to put 1440, and I'm going to delete the rest. There's nothing wrong about the answer if it looks like this. It's still the same thing. Right. It's still the same. You see, even if you add the two, they'll give you that. Okay, the answer here at the end. All right. Now I believe that I've dealt with almost everything in this exercise. This exercise should be sufficient to carry you guys through on Monday in the exams. Thank you.